They will create momentum ignition, rapidly placing and canceling orders to create artificial price movement. So the whole purpose of detecting the toxic order flow and predicting this liquidation cluster is to understand when inside a trader, someone who has more information or more capital, more sophisticated algorithm, you can ride the wave.
Do people think enough about the role of these market participants and how to think about their strategies?
If you just take a trade, one trade when the gamma exposure is negative, you have one of the easiest trading.
People will be able to use Bitcoin as the settlement money, like a big bank. And like when you have spare cash on hand, you could start to run it into a carry trade to collect the interest rate. And there are no other product that is having liquidity, yield, and the capacity.
Maroli and Gecko are the co-founders of KingFisher, which in their own words gives you X-ray vision into the blockchain markets by tracking liquidations, gamma exposure, toxic order flow, and much more. The duo met on the internet where Maroli was teaching AI to trade crypto and Gecko was playing hide and seek with market liquidity. Since combining forces, they've built a suite of tools for uncovering the nature of market liquidity that helps traders determine where the market goes next. And in fact, Maroli once predicted the exact bottom for BTC 6 months before it happened, for his girlfriend, no less, with one look at the liquidation map. So if you trade with leverage or think you want to, these guys have a word or two to share with you. Maroli and Gecko, thanks for joining me today. Your work on liquidity references research in traditional markets such as toxic order flow, Gex Plus, and dealer flow, as well as carry trade. I'm going to get into all that. But first, I want to ask a question. Is there a crypto guru or even a macro trade guru that has inspired the development of your frameworks?
Well, everything started actually with crypto IS, with Arthur IS from Bitmex. When we noticed, when Gecko noticed that the transactions were happening a bit too often compared to other exchanges and the candles were a bit more deep, that's where I noticed that there's something funky going on with liquidations. And by starting to analyze them, we figured out, okay, how can we predict liquidation clusters, zones where liquidation will happen, and how can we profit from it? And also, there was some arbitrage to be made between Bitmex and other exchanges. So I would say Arthur IS was one of the beginning of it all.
Well, I want to double click on that one. For many people, Arthur Hayes was their journey into just being a degen, going down the degen rabbit hole and looking for as much leverage as possible. You guys went a more sophisticated route. You really tried to take liquidity and leverage and actually break it down in more of a systematic way. What's the background there? How did you come to think about it in such a robust way that's led to a lot of the tooling you've developed?
Yeah, thank you. I think, the first place was to study what was the market, what was happening. So Bitmex was the leading crypto derivative exchange in 2015, which was quite incredible if you think about it. The $1 billion volume on a daily basis was quite a significant change into the crypto realm. And we could have seen that the index underlying the swap, the perpetual swap, was made with Kraken and Coinbase, which was nothing in comparison to the actual liquidity we can find on a daily basis. And it was so easy to manipulate the spot market. We found those amazing inefficiencies. And especially the volume of traders was so high, the exchange was like crashing every day. And you get this matching engine, liquidation engine, freezing and liquidated everyone. And so it was a daily thing. Like even Arthur IS was going to his platform to say, hey, I need a new Lambo. Can you just get liquidated today? I need money, right? And he built the biggest insurance fund in the crypto realm. I think it's around 350,000 Bitcoin today. It's like a couple $1 billion. It's a huge amount. It's the biggest, I think, change that ever happened. Even the government started to want to take a part of the pot, and they went into court to arrest him using the Department of Justice. And it shows how the crypto realm is like evolving on a daily basis. And if you make something great and the Department of Justice is coming to you, it means, at some point that you did something illegal, but as well that you have a lot of money to get and gather. Like they will always follow up the big guys.
Well, Arthur Hayes, if you ever want to have a conversation with these two and speak more about their how they've broken down liquidity and what you did on BitMEX. We'd be happy to facilitate that conversation. So the background is you guys really started looking at what was happening on BitMEX, and I know then you looked at some of the other exchanges, but you were starting to notice these patterns that were playing out in the marketplace, with some of the liquidations, even with some of the issues they were having at the time. I think you just mentioned BitMEX would go down, the liquidation engine would have issues, execution engine would have issues. So there were a lot of challenges at the time. It's a different beast today, and that actually is a good segue into, I think, the first topic I wanted to cover today, which is this concept that you guys have around toxic order flow. Because so much of the marketplace is looking at the trades that are being made and what that order flow looks like. And you guys have taken a concept, I believe it happens, that's more from the TradFi market, applied it here in the crypto market to drive deeper insights into what this order flow looks like. So for the audience, can you break down specifically starting, okay, what exactly is order flow, which I think is more known, and then this concept of toxic or toxicity and how you guys look at it?
Sure. Of course. The toxic Orderflow is really interesting. As you said, it comes a bit from trade from markets. So to start with your first question, what's trade flow? Trade flow is simply listening and looking at all the trades falling in what we call the tape, right? So all the trades made from traders. Basically, by analyzing those and checking the prices they happen and the size of those trades, also by doing some interesting aggregation, you're able to start identifying outplaying orders, right? So orders that fall out of the normal distribution of current orders. And by aggregating those and looking at those especially, you start figuring out what's the toxic order. So where the toxicity in the market is coming from, which orders falling in the tape are toxic, which one, let's say, are more of the normal behavior of the market. What's interesting with the toxic order flow is that it always adapts to the market's, let's say, general behavior. There will be dumping or pumping or ranging or whatever happens in the market. We always analyze when we are going up, down, or sideways, but which orders are actually significantly different from all the other orders. And by looking at those, you're able to understand the toxicity of the market, and you're able to take a few different, let's say, conclusions to help you build a decent way.
I think a lot of listeners would almost expect that this toxicity, because there's a concept there around uninformed and informed trading. Is there not?
Yeah, indeed. You get the toxic order flow patterns. It's like trading activities that are usually detrimental to liquidity provider and other market participant, either because someone is informed and has more information. It's like a pattern that's by definition mean that it will make unprofitable most of the other counterparty. And it's like due to information asymmetry or sophisticated trading strategies. And so the game is like to find those characteristics following up, like what would be the superior information they might have. Like, for example, yesterday when someone said, okay, I will dump 50% of my Apple share because I know that the Japan market will collapse. And so you have superior information and you just directly take action, right? It may involve like large orders because, you know, as the correlation between the S&P 500 and the Bitcoin market, you will have like large order that will move the market significantly if you're following up. So everyone will like be doing the same thing, you know? So if you are the first mover as a whale, you can have like exploit the market microstructure or latency and try to take advantage of this. So the game is like adverse selection to find what's the favorite price to the traders and detecting the toxic order flow.
So let's talk a little bit more about this from a trader's perspective. If you're able to, you have the sort of the range of normal behavior that's happening, which would be non-toxic, right? Then you're able to identify this pattern where the toxicity has come in. What is the benefit to a trader? Because I think there's at least, for example, I think one of the things you talk about, and you have a great article on it, we'll link to in the show notes, that really breaks down a lot of the concepts, has some charts in there as well from your tooling, talks about the idea of this reversion to the mean. So if you see a move that happens on the toxicity, then you could expect some reversion to the mean. Can you unpack that a little bit more? See, explain if I got that characterization correctly, and if not, kind of take
Yeah.
it and describe it a little further?
Definitely. I think one thing we can think about is the predatory hunting behavior. So basically, when you don't have that much volatility, but the price is kind of drifting into one direction, you will have like this aggregated liquidation from many retail traders, and you might have a market maker, well known like DWF, that have been doing this kind of things. Others that are considered as toxic market makers, that because they do toxic order flow to other market participants. Then they will create momentum ignition. So it's rapidly placing and canceling orders to create artificial price movement. And the idea is that by spoofing as well the order book, placing like large order with literally no intention of executing them to manipulate the other trader's intention, you can kind of spark the movement, and igniting the situation will like a oil, it will just burn quickly, and you will get a cascading liquidation that arise, and you get like
Mm,
those liquidation clusters that aggregate, and we try to predict that will get liquidated, and the exchanges, the risk engine has to take them up quickly, otherwise they would lose money and there won't be enough money in the system. So the whole purpose of detecting the toxic order flow and predicting this liquidation cluster is to understand when an insider trader, someone who has more information or more capital, more sophisticated algorithm, you can ride the wave and understand the intent and not follow up a fake move that is intended just to trap you as a trader. That's the only purpose.
got it. Got it. Now, is this just from a time perspective? Because obviously, some people are trading more days, intraday. I think some of the charts you shared with me before offline, some of them are even in minutes. So, is the toxicity that you're looking at, is it more on very short time frames, or are you able to also identify patterns at larger time frames or larger intervals?
So
You check any kind of time frame, because what's interesting about so as we mentioned a bit earlier, the toxic order flow shows you relative to the current market behavior, which
Mhm.
orders are deemed toxic, which orders are out of place. So if you look so I mean, of course, we look at the transaction level, but then we aggregate this data on different time frames, so 5 minutes, 15 minutes, 1 hour, 4 hours. So even if you look on 4 hours or daily charts, you're able to still notice on which candles toxicity of the order flow was unusually high. Right. So this can tell you on different. I mean, sorry. Then depending on the time frame, you will always see which candles are more or less toxic. But then, of course, the mean reversion, let's say, behavior markets when we see toxic order flow spikes is of course different from one time frame to the other, right? So
Mm.
if you look at 5 minute chart, for example, it tends to mean revert much faster than the daily chart. Makes sense?
Okay. Yeah.
But outliers on the daily chart might give you more, let's say, macro information, correct? But the same way for liquidation maps that we provide. So we see different, on the KingFisher, you find different kind of configurations for the liquidation map, and you have more or less long-term views of the market's liquidation. So for example, if you look at high leverage, we're going to study very short time frames. If you look at all leverage or low leverage, because this considers, for example, 2x, 3x, and 5x leverage, those tend to get liquidated much less often, right? Because they require much bigger market moves. So this also gives you different ideas of where we'll go long term. You mentioned in your introduction that I told my girlfriend where to buy Bitcoin a few months in advance. And this
Yeah.
is exactly the way we did it, right? I did it. I took a low leverage map. One day when she told me I want to buy Bitcoin, I said, okay, no problem. I took a low leverage lick map and I looked at, okay, well, the bunch of the liquidation. All right, fine. Put an order exactly at 16 something K. And then forget about it. And one day she woke up to an email saying, okay, your order was filled exactly at the bottom. The market bounced and she got it. So it's always interesting, as you mentioned, to look at different time frames and to understand the implication of different time frames, given different metrics you look at, right?
Well, what I'm taking from that is that this is a great way to get your girlfriend, also to either get a girlfriend or to maintain one or retain one if to
Be
show that
careful,
you
if
understand
you push
liquidity.
leverage too much, you might lose your current friend. So you have to be,
Yeah,
yeah.
maybe that's some advice for Arthur Hayes as well, is giving out leverage like it's candy. with Bitmex. Okay. All right. Well, let's talk a little bit about you. You just mentioned exactly. I mean, that's a perfect use case for exactly how a trader or long-term investor could actually be using one of these tools to kind of understand when they could actually be looking for an entry point. I noticed something else in the article that I mentioned that you guys wrote before. You talked about spreads widening during these periods, and so are there specific? I have a question here. What are the specific mechanisms by which market makers widen their spreads in response to toxic order flow? I think that was the concept that you shared in that article. Can you expand on that a little bit?
Yeah, so the mitigation strategy from the market maker is that first they will widen the spread and reduce the liquidity to protect themselves. So because the toxic order flow lead to consistent losses for the market maker, they want like low volatility and dual side like liquidity coming, buying, taker flow.
Mm-hmm.
They don't have any interest to provide liquidity like today. Let's say someone do a 50,000 sell off of Bitcoin, you have no interest to provide a 10 BPS spread. So they will quickly increase the spread and it will widen even more over time. And also they will have their own inventory that they will need to delta hedge if they didn't found enough liquidity at any point. And you get like this like this active circle where you get more and more market maker who need to widen the spread together, and you get less and less liquidity together, and it just like increase the volatility for at some point. And the best dealer will have option inventory, and these ones will benefit from this because they will be like doing dynamic hedging of the delta of the option delta they have. And by trading this way, they will create like momentum back and retracement quickly. And also another thing they will do is like they will skew the bid-ask spread. So let's say you got a big hedge fund who arrived today and said, okay, I need to cover my Bitcoin exposure. I need to buy a lot of put option to cover my inventory. So they will call a dealer, do a block trade, and the dealer will take a huge premium on this because the implied volatility is really high.
Mm-hmm.
And they will use the proceeds of the P&L to skew the bid-ask spread at their advantage, and they even themselves might be taker and increase the volatility themselves. So they have enough money to capitalize on this. And not only they will delta hedge first, if they already found the liquidity, they will take advantage of the order imbalance on the order book from the other market maker removing liquidity. And so you will get like this huge volatility spike and momentum ignition coming together. And if you have this momentum ignition, you might also have liquidation cascade in the middle of it. And so you get like all those effects together that increase at the maximum speed the price velocity.
So there's a bunch of concepts in there that we could unpack, and part of that gets into the next kind of topic I want to cover, which is looking at the GEX Plus, which is one of your metrics, and talking a little bit about options dealers, because there's a lot of insight there that we can get into. But before we do that, I guess, Maroli, I want to come back to you and ask a question. When a lot of traders, advanced, intermediate, well, particularly beginners, and I would say even intermediate, when they think about trading, they're looking more at price levels. They can look at technicals. They can look at a variety of pieces of information. I don't hear enough of them talking about who they're trading against, right? In this case, we're talking about the market makers, those who are actually provisioning liquidity to the marketplace and the strategies that they have in play to stay profitable. And if you understand that, then you can see how these patterns that you're starting to look at from toxic order flow or other patterns that we may be getting in today can start to materialize and give you a better insight into how to think about trading. Do people think enough, do traders think enough, specifically in crypto, enough about the role of these market participants and how to think about their strategies?
I don't think so. I mean, especially if you're looking at, as you mentioned, let's say, I don't want to say beginner traders, but we usually call them retail traders, right? Retail traders, uninformed players, have, especially the unprofitable ones, have a tendency to overtrade. They see the markets, they see a move. And so, for example, here the past day we dumped a lot. They will tend to get feared, scared, and to sell as well. Or they will tend to trade along with the market. There's a lot of market orders. Doesn't mean that market orders are not good, but they are very expensive. And if you don't trade effectively, they eat into your P&L a lot. One of the, let's say, best advice I could give to retail traders who are losing too often and too much, is to learn to sit on the hand, of course, which is one of the hardest things in trading, right? Over trading is incredibly easy. All the, let's say, how do you say, all the exchanges have a lot of flashy colors, moves very quickly. Finance just put 1 second chart. Everything is made like a casino to make you play as much as possible. And your challenge as a trader is to only trade once you have, let's say, conviction, right? When you have actual planned out trade, not to overtrade when you feel like trading. Like it's Monday morning, I wake up, I don't have anything to do. Let's make a trade. This is not the way to do it. And this is why the way, I did it to my girlfriend. She woke up one day and said, I want to buy Bitcoin today. I said, no, don't buy today. Wait for liquidations, wait for an event that gives you want to buy, that gives you a cheap price. And the cheap price is big market liquidation that gives you a big deviation, right? But,
Sure.
But then you put your limit order, which is great. You will pay less expensive than the market order. And then you wait. And then you go enjoy your family, touch some grass and stuff, and wait for your order to hit. A lot of traders are very impatient, right? They think, okay, market is going up, but tomorrow we go to 100K tomorrow. But no, it takes a few days, few weeks, few months, right, to move a lot.
Sure. I want to add to that. We had a options roundtable several weeks ago, maybe months ago at this point, and one of the points that was made was someone talking about that, how when they first started trading, they were really maxing out the amount of trades and leverage that they were using, and then over time they've really cut that back, and they're still around, which I think says something. And they said they've cut that back to really look at fewer trades, the right trades, really waiting for those pitches to come in.
For example, here. So a few weeks ago, we were at 70K, right? If instead of buying at 70K, you looked at low leverage liquidation, even all leverage liquidation maps, for example, you would have already gotten more than 10% discount on the price you wanted to buy. And then if you look at low leverage liquidation, you actually got the 50K. We called it yesterday. You actually had the 50K written on the low leverage liquidation. So if you just take this map, put your 50K and wait until instead of aping at 70K, then you make 20K already on each bit when you buy, right?
Yeah.
So it's, you don't make it yet, right? The market needs to bounce, but at least you don't buy 70K.
Keep you away from buying the top and selling the bottom. That's what these guys are here for.
Yeah. Also,
I think strategy, but it doesn't work very often.
Another one that's good, that you can use on a daily. It's you look at toxic order flow, you look at the move, you look at where the biggest toxic order flow happened on a day that haven't been mean reverted so far, which means that at some point the dealer has created a bid-ask spread skew somewhere, and you just have to look at where he started to move to do this, and you can expect that at some point he has floating delta somewhere. They will close at the highest profit possible, and from that you can expect as well with a liquidation cluster. Okay, so it will move back down to this cluster, and it also has an open toxic order flow that haven't been mean reverted. And you can just use both the data together to get the big lines. And now if you want also the volatility, weather, you can look at the GEX, and it will give you even more insight for the detail of the moment. But it's coming together. You have many ways to profit from predicting toxic order flow in the crypto market. That is really high, actually. A lot of insider trading in shitcoins and everywhere, actually.
Well, I'm imagining the traders being able to surf from these liquidity clusters. But you mentioned GEX Plus. I actually want to use that as an opportunity to kind of drill into that a little bit more. Just looking at my notes here, we were talking about the importance of options dealers and the positioning that they're doing and what that means for future price movements. I wonder if one of you guys could explain what exactly do options dealers, what's the role that they play in the crypto markets, and why should any retail trader know about them and what exactly they're doing?
Sure, Sam. And actually, you kind of touched on the point we just addressed, which is learn to sit on your hand.
Or get okay. So I did. Sorry, I got to point out here. I think it was Kobe, who's an OG in this space. He said he bought a PlayStation. So if you're having difficulty, you don't know what to do, buy a gaming system That's the best advice I can give. Get something like Grand Theft Auto, something non-violent, right? Of course.
Get the World of Warcraft subscription and do only this all day.
That's right. That's right. Okay. So yeah, a little bit of alpha there. All right. Sorry, Marola, go on.
So basically the gamma X, so the GEX plus is the gamma and vanilla exposure of the market of the option dealers. So as the question you just asked, what do option dealers actually? What do they do? So they are market making option, the option markets, which is mostly on derivative nowadays. Actually, almost essentially on derivatives. The thing is, option dealers, their job is to market make, so they need to remain delta neutral, right? So their own objective is to sell as much options as possible while remaining fully hedged, right? So if the market goes up or down, if Bitcoin, Ethereum, whatever, goes up or down, their, let's say, balance, right? Their equity should be exactly the same as much as possible, right? This is their job, and they can make all the premium of selling options. But so how do they do this? Because they will sell a lot of puts at different prices, different expiration. They will sell a lot of calls, different prices, different expiration, and so on. So it's very tricky thing, let's say, to compute. But by listening to all the option trades going in the tape, right? Going on in derivative, for example, you're able to, there's good ways to estimate accurately which trades are made by retail traders. So the counterparty is mostly the option dealer, or which trades are made the other way around. What I mean is, by listening to all the trades, you're able to know which risk is being taken by the option dealers. And by understanding which risk they're taking, you're also able to understand their hedging needs, right? What they need to do with the future market and spot market to hedge their bag of options, right? They just bought. Because if you sold a put 2 days ago, the market goes down like this, you pay a lot of money at the bottom, right? If the guy is exercising. I mean, if the option is being exercised and you sold the put and the market goes down, you're going to pay a lot of money. So
yeah,
so this you will need to short a lot of virtual futures, for example. So the PNL you make on the futures is going to pay back the loss you're making on your option. And basically, by analyzing all this behavior between the different expiration, different instruments, different prices of exercise, different expiration, different prices, call, puts, and so on of option trades, you're able to know exactly how much the option dealer has to buy or to sell in terms of future markets to hedge their portfolio. This gives you a very interesting insight in the markets because, for example, if the gamma exposure is positive at the current price and current volatility, so because the GEX plus is gamma, so the index volatility, the index variation, and the implied volatility variation, the vanilla exposure. So by analyzing both of those and checking where we are right now, you're able to know, okay, right now, if the market goes up, if the GEX is positive, if the market goes up, the option dealer has to sell the instrument, the pair. If the market goes down, he has to buy the pair. So what's going to happen if the GEX is positive is the option dealers will have will be a stabilizing force in the market. For every dollar up, they sell. For every dollar down, they buy. So the market will tend to, in a way, run, right? Then, of course, the option dealers have different ways of executing the orders and stuff like this. It's not that easy, but I mean, it gives a very good indication.
And
on the other way around.
And the other way around. Yeah, I want to add just, it's that you get like this daily trading activities that will change over the day. So sometimes you will have like the people buying option because they need the edge. Sometimes you get speculation and you want people that want upside exposure or downside exposure. Some people will like buy straddle. Like, so what we've seen today was like a huge amount of buy of straddle. And so what creates the market is that the straddle creates the dealer stabilizing force because it's a kind of a reflective and is getting negative gamma and is trading the delta. And so depending now if the straddle is losing too much value, the hedge fund will unwind the straddle and be like, okay, so now price is stable at this range. I don't want to trade it anymore. I want to get out. Or the price jump enough and they want to take P&L out. So they either lock in the P&L with a perp And so you get like huge inflow of perp, or you get unwind of the straddle itself. But usually you don't have enough liquidity for that. So you will see like inflow of buy or sells it can be at the top of the bottom, depending.
Yep.
But just to add to this quickly, so we
Yeah.
mentioned positive gigs, Rico also just mentioned, and give the example. But what's also very interesting is when the gamma is negative. Gamma and is negative. When the gate plus is negative, the option traders need to trade along with the market. So if the market goes up, the option dealers need to buy. And if the market goes down, they need to sell, which means they keep pushing the market the way it's going, right? So that's where you see increased volatility. Then volatility is going to expand usually. And that's when you're going to see like those gut candles of 5% or whatever. So actually, again, to touch on the point of knowing when to sit on your hands, if you just take a trade, one trade when the gamma exposure is negative, which is once a week, maybe once, doesn't happen so often, but it's definitely worth keeping an eye on. And you target liquidation. On the side, the market starts moving. You have one of the easiest trade you could take, but you need to wait for it.
Yeah, so it's about waiting and studying the gamma exposure. Okay, we're recording this on August 5th. For anybody who's going to be hearing this later on, you'll know that there's just been a market correction, so to speak, right? And there's a variety of reasons. In fact, we were talking offline about what could cause that. When you see these kinds of moments, I mean, I hear some people call them 20 sigma moments. I'm not sure if that's quite correct, but when you're seeing moments like today, how are you using that in the moment where you're having a massive amount of volatility? Are the dealers then, is that dynamic hedging happening at a rate that's even hard to even be able to react to? Is this a good time to actually be looking for a fat pitch? Or how do traders use some of this tool when you're looking at gamma specifically to think about, is this sitting on my hands time, or is this a fat pitch opportunity?
So if you look at the gamma exposure, the GEX Plus, we'll keep calling it GEX Plus from now. It's much easier to say.
Fair enough.
So we have a widget on the KingFisher, right, that shows you the GEX, and we make it very evident when it's positive or negative. So when the GEX is positive, the whole picture is going to be blue-green, right? And when the GEX is negative, it's going to be pink, red, violet. So you have a very strong, let's say, visual signal of when it's positive or negative. That's number one. Another thing that's interesting to note, which I didn't mention, I cannot touch, but so as I mentioned, the job of the option dealer is to stay edged as much as possible, meaning he wants his GEX plus to be zero. When the plus is zero, that's when the market moves up or down, he doesn't have to do anything, meaning he's edged. So actually, you will see the GEX. So the GEX evolves continuously, actually, trade after trade after trade. So we update it, right? As the GEX evolves, the option dealers will always tend towards the zero GEX area, right? Which is on the KingFisher map, the transparent area. So you will see, if you see like a, let's say, purple color, which means the gamma exposure is negative, let's say to the downside, and then you have a zero GEX below this purple area, then you will tend to see the market going through this purple area. So the market's dumping all the way through the purple and stopping at the zero GEX, right? And not the other way around. It works as well.
Okay.
Does it make sense?
It does, yeah. And actually, unfortunately, I think
No, I'm here.
Gecko, do we have you back?
Yeah.
Oh my gosh, you come in like Batman, just come in through the through the
Just went
ceiling and
hunting
show up
some
and
places quickly. My back.
That's right. Yeah, he's checking on the gamma right now and figure out if he has to close out some positions. No, I think that's very helpful for traders to be thinking about how they can actually use these tools and put them into play. I want to ask then, we just talked specifically about today. We have a high volatility moment. How you've had this tooling for a while, and I don't know how long, so maybe you can elaborate on that. How has this evolved now that we're in a post ETF world, that so much of the options activity is happening on Deribit? The market is at least somewhat more robust than it was, let's say, 2 to 3 or 5 years ago. Is that changing what you're seeing in terms of dealer activity and how they are hedging their positions?
we can see that the option market is maturing. So it's really hard to say, it's like a kind of shadowy thing. If you don't trade with them, you don't have any ideas about what's happening. I mean, I would say that the market is getting good. Main market maker are still making huge profit. They keep on building and creating new products. We are going to see a structured product soon, and the rise of it through the DeFi space. And this will create, again, new type of path dependency dynamic hedging related activities. And all of this is quite interesting because it means we can build new tools to study those behaviors and those new type of clients coming from the ETF world, like the most sophisticated players. They won't buy a perp on Bitmex anymore. They will buy a structured product like the auto-callable on their favorite Goldman Sachs dealer somehow.
What? Why is that? Why is is it just the level of sophistication of risk hedging is so much better with these structured products than just buying them using the term naked if you're just buying a perp, being long or short?
Yeah, I would say it follow the basic risk policies from those big hedge fund manager. When they get a $1 billion exposure, they can't allow themselves to get more than, let's say, 10, 20% drawdown on any type of asset. They have those risk policies. So what's interesting with the structured product, and they can capture some yields if the Bitcoin price get to the upside, and they got a capped drawdown. So this is the main thing. And also they will be able to pass big amounts of orders through this, and then you will get the dealer having to create this underlying expectation on the market to see how they can execute the position properly and keep the delta hedging at any time.
Fascinating. Well, I love this notion of gamma and thinking about the options dealers and for retail traders specifically, because I know many of them tune in. It's really understanding how the opposite side of the table is playing against you and what they're looking to actually achieve to be able to take that for your advantage. I think you guys talked about momentum and being able to use the movement that they're going, either when you're looking at toxic order flow or you're looking at their gamma exposure for the moves that they may make. I want to transition though now a little bit to a topic we've talked about offline. I mentioned on X you guys have talked a little bit about the carry trade. We talked, I think it was our very first or second conversation. You recommended a great book, The Rise of Carry, which again, I'll maybe even give a link to that because it's been such a great read, even though I'm not even close to being done with it yet. But you guys said something that I found very interesting, right? You talked about the carry trade for crypto. And I think you guys are thinking about it a little bit differently. But I want to start off with unpacking for those who are less familiar with the carry trade, what exactly is it in a traditional sense? And then how do you guys think about it from a crypto lens? So I'm not sure, Maroli or Gecko, who's best to kind of kick that off.
Yeah, I can jump on it. I mean,
Okay.
the carry trade basis is the main idea to capture some yield between two type of currency or any type of derivative product, or you have like yield product and you try to make some kind of arbitrage between one and another. So the main carry trade you can do in crypto space is the basis trade, where you collect the funding rate from the perpetual swap on the future market. So the trade is quite simple. For example, you buy Bitcoin and you sell the paper Bitcoin on the derivative exchanges. And to do so, you collect basically 1 BPS, 0.01% every 8 hours. Depending on the funding that comes related to the demand for speculation and leverage, the funding rate can oscillate and it can even turn negative. So in this type of situation, you will be the one paying being into a carry trade. So that's why you're going to see carry trade on Bitcoin being more safe than any type of shitcoins, even if the funding can go really high, even like 4%. Just because for the main reason that if you need to unwind the carry trade, there is no liquidity to sell back the shitcoin. No one is willing to buy them. So you are going to have huge slippage on your exit of your carry trade, the unwinding. And this unwind will cost you more than any type of interest you will have been able to collect for the period. So we can talk about the rise of carry trade in the world and how when the unwind arises, you see massive crash and collapse of the currency. Today with the Japanese currency, it happened in the past, like in the 80s. And we are going to see this again. And one day Bitcoin will also be a victim of the carry trade, the unwind of the carry trade. We can even say that right now we have been a witness of a carry trade unwind of Bitcoin, and we can see how much the impact is on the market. However, the base is still positive today, so it's good. It's around 10% a year. Yeah.
Okay, so yeah, I want to rewind that just a little bit. So the carry trade being where you basically you borrow in a lower cost currency or a lower cost interest rate, and then you invest it somewhere else that's going to get a higher interest rate, right? And you arbitrage between the two, the funding rate and the yield. And then from a crypto perspective, you talked about being able to do that just from a futures perspective, right? Where you're able to buy spot and then long a future. Did I hear that correctly? Am I getting that right?
Yeah, exactly. You correct the difference between the yielding currency or assets to profit from the interest rate differential.
Okay, so you've got people that are you could ask the initial question, right? Which is why is this a popular trade right now? And if it is, who's taking it?
So today we see that there is this company that's been created called Ethena Lab, and a success story we can say definitely, because in less than 3 months they raised at least $2 billion. I think this is never seen, even in the realm of the classical TradFi investment, to fundraise $2 or $3 billion from small players. It's huge. I mean, maybe they are backed by some people, but we can say that the basis trade has been institutionalized by these people, and they propose to use this. And it's like basically the Nakama dollar that have been created by Archer IS, like the synthetic cash that we can think about for what crypto can become if we are able to create cash out of the banking system and any central bank.
So Athena Labs is one. They're taking advantage of this, and they're popularizing this trade. What about some of the larger participants in the market, the hedge funds? Because this topic of a carry trade or selling futures against spot is something a lot of people have been talking about for companies that are buying the ETFs that just came out earlier this year for Bitcoin, buying that and then longing that on like the CME. Is that happening as well?
Yeah, we are seeing some different type of hedge fund mid size, like between 10 to 100 mil, that's getting into the basis trade as well. Yeah.
Okay. So what I guess what I'm getting at, the sophisticated players understand what carry is. They understand how to approach it, and they're doing it right now. Are you seeing this a lot with retail outside? I guess with Athena you are because you've seen as you said, in just a couple of months, we've seen a large size of over $1 billion, I think is what you quoted. Are we seeing enough where individual retail is doing it? Because I thought that was a part of the conversation that really caught my ear when you and I were talking about it offline. But this is an area where the average retail investor can be looking to actually get a good yield on their Bitcoin product.
But don't forget they need to be careful, right? For example, you might have heard of the Luna collapse. Lots of people do this. They started borrowing whatever money they could borrow, put their house, whatever in collateral, or put their money for the future studies of their children. Take this and put this in Luna that was yielding 20%. But as soon as Luna stopped yielding 20%, then everything collapsed. You're stuck having to repay your loan. So it's also interest. So what's good about the, let's say, future carry is that it's fairly safe. But if you leverage it too much, it can start getting dangerous, right? And we see it, for example, with the well-known Japanese carry trade that's just being unwound right now as the Japanese central bank increase their rates. As soon as the money you go, yeah, sorry.
Yeah, I would say that coming back to small retail users today, that's if you want to do a carry trade on the yen, it's still kind of technical, and you need to go through banks and everything. And depending on which country you come from, you get the KYC, the AML, that will say, sorry, you're from Pakistan, so you are not able to get into it. You're from Turkey, you're from South Korea, you cannot buy US bonds, right? Like, and if the broker agrees to sell you something, it still take a huge spread. So before you make any kind of money with the fees, it's like a mess. And then it goes back to the system, and you pay your taxes, and you don't even have much visibility on what you're doing. What we can see today as the future of the investment is that people will be able to use Bitcoin as the settlement money, like a big bank. And like when you have spare cash on hands, you could like start to run it into a carry trade to collect the interest rate. The interest rate is like the international rate for needs for Bitcoin overall in the world and speculation coming together. So if you don't want to speculate on Bitcoin, you don't believe in its future, you can still collect 10 to 20% APY just by lending cash to the crypto market. And then all the crypto exchanges will spread, and arbitrager and market maker will spread the word and say, okay, there is this capital available into the market we can use, and people will like get this funding paid out to you, and the dealer will find the money for you basically, and they will do the hard work to connect every venue and everything.
Mhm.
And you as a user, as a little guy working hard, you can save money every month and start saving into Bitcoin, and not Bitcoin itself, but into the Bitcoin carry trade, and
Mhm.
collect the funding. You have expectation that the Bitcoin liquidity will be here tomorrow morning and will be here in 5 years from now and 10 years. Maybe Solana won't. Maybe other shitcoin won't be there. Maybe I will mention shitcoin that will not even exist in 10 years. And it's like, I'm talking about the carry trade on Bitcoin because Bitcoin is here since the beginning, and it's like the first mover. We are going to see the rise of the carry trade from the little guys that say, so either I let my money in the bank and I get 5%, but the interest rate is like 10 for bonds. And if I do insurance, life insurance, my interest is 8%. Okay, great. But still, I need to wait 50 years before getting back get back my money. And like, there are no other product that is having liquidity, yield, and the capacity, which means that you can today, I think, pass at least $5 billion into the carry trade, and like $5 billion of little guys. And this will grow over time with more and more people getting in. If everyone used Bitcoin as a global bank and everyone used the future market as the way to collect the carry trade, then we are going to see a kind of move that says, I want to be paid in Bitcoin because I can convert those Bitcoin in carry trade and I don't get taxed until I sell those Bitcoin.
Mhm.
And the governments can't really do anything about that because they know. And so what they have been doing for like the last 5 years is that they have been banning future market for every country that has a lot of money. Every productive citizen are not allowed to use the future market on their country. European and American people are banned from the derivative exchanges for this reason. If everyone started to collect 10% APY out of the banking system, out of the government view, and they go offshore, and they can use this Bitcoin carry trade interest to pay for real thing in real life, like they can pay for food, they can pay with different thing, then it means that everyone will start using this, because why would you uh, accept to get a direct taxation on every single income where you can just keep the floating interest going together, and maybe when you need a little bit of cash, when you want to buy currency of your country, then you pay tax, of course, because you're buying dollar, you're buying euro, you're buying yen, you're buying yuan, right? You need to pay the tax is when you put the money in the bank account.
Gecko,
Otherwise, you keep it in
right.
crypto.
Gecko, I mentioned before we started the show, I wanted to make sure we got into something that would really strike the passion chord, and we talked about we talked about liquidity, and then we get into the carry trade, and all of a sudden Gecko's rising up. I can actually see the feathers coming off his back. I love it. I absolutely love it. I love the excitement and the passion there, and the vision actually that you have. So I see what you're saying from a positive standpoint of being able to get yield off of an asset, in this case, Bitcoin. I think to summarize your views, both of you, on the value of the carry trade, there are some risks involved, right? And one of them is liquidity, which is why you suggest Bitcoin over other assets. The other one I think is what you could be considered like liability time frame, right? Like, when do you actually need the money? How quickly do you need to get out of it? Is there going to be a rush for the door? So I want to unpack some of those risks a little bit more. Maybe Morley, go back to you because I know you were highlighting some of those. If someone's looking at taking their Bitcoin, using it as to get some carry, walk through exactly what that trade would look like, which I think we did, but I just want to highlight it again. And what are some risks that they should be considering before they actually execute that trade? Oh, Merle,
So
you still
there's
there? Oh, okay, yeah.
yeah. So a few things to consider as you just mentioned. So as also Gecko mentioned, so what the carry trades to go back, it's you buy, let's say for Bitcoin spot, right? And then you
Mhm.
sell future. And this is fine as long as the spot and the future are completely correlated, right? And move exactly at the same way. Where you will have an issue is when you try to unwind. Now, when everyone is trying to unwind, so then you will have to buy back your future position, right? And sell your BTC spot. So number one, if you have very big trades, very big size, this might, you might have to incur quite some, quite some slippage. Number one, this will incur costs. Number two, negative funding. Then you will have to pay actually keep your short open instead of getting paid for it. So historically in the crypto market, this is fairly rare, right? I think we check quickly, there's some statistics about this on Ethena.
Yeah, overall it's like less than 5% a year.
Sorry?
Less than 5% a year maximum.
Yeah, exactly.
Just to
Also, it's
clarify,
still
that's,
risky to
that's
over leverage when you open
Yeah.
your trade or your carry trade does, let's say, badly timed in the market, you end up paying for this, right? So if
so
you
there's
are
less
completely
than
over leveraged, could
Yeah, I
start
want
getting
to clarify that point though. On that 5%, you're saying there's 5% of any given year in which the price of the futures contract is going to be below the spot price.
Let me check the actual number.
Yeah.
So it's
But is that the metric? If it's 5% or higher, but that is what we're looking at, right?
something like
Okay.
this.
It's like the amount of time where the negative funding means
Oh,
that you are
okay.
paying,
Got it.
which means reducing
All right.
your overall cumulated yield over the year.
Yeah, I
So-
can find it. I'll find it.
I think the main risk, I would say the main risk into this carry trade, the biggest risk of everything of all is the custodian risk that's come with the exchange collapse that can rise, like FTX style, Mt. Gox style, exchange hack. And so there is a way to avoid this kind of situation. And the way is really, really easy. The exchange need to have a third-party custodian, which means that all the funds are actually held by a segregated custodian that manage the money and have a view. As I mentioned, just the biggest risk is the exchange collapse or scam exit. So to avoid this kind of situation, you need to use a third-party custodian. So today we have many ways to do so. We have Copper, you have Fireblock and other kind of situation like that will manage the money for you. So the exchange is segregated from the market making activities and is segregated from
Holding the funds. It makes some other, it's not, I don't want to call it issues, but it's inconvenient because as soon as you want to, let's say, withdraw your fund, there's like some withdrawing the windows, right? Times a day or something. It's quite minor, but at least for the security, the additional security you get from having those third-party custodian, it's definitely worth looking at exchanges like CoinCore, for example, which takes this kind of security very serious.
So that's a key risk. And Gecko, you talked about mitigating that, and I'll let you finish because it sounds like you have something else you want to talk about that. When you do that, can we talk a little bit about managing leverage? Because I know in the classic carry trade, leverage is a key component for profitability. What about here? What are some considerations that people should be considering for leverage? Because obviously we're not looking at this to be 100x leverage long. This is really trying to be a sort of lower risk but yield based product. So Gecko, if you could kind of take that and talk a little bit about leverage considerations as well as what you mentioned for the custodian.
But on a carry trade, you're not supposed to have at the beginning any type of leverage. You should be on one-on-one. If you are able to use more collateral, you can do indeed some margin borrowing on the exchanges. So you can deposit USDT and margin borrow some BTC and at the same time do the perp. So this is a way to do a leverage carry trade, but this implies that you have good connection with the exchange, that you have at least enough volume, and it's not easy to make in practice. The other thing is the cost of opportunity. Basically, if you find something that yield better, let's say the yield has been crushed by Ethena and other hedge funds. They have been like chunking $5 billion on the basis trade, and now the basis is near zero. You have no interest to stay in the trade. And also, maybe the cost of opportunity is quite high if you find something else that has a better yield, right? So it's always a matter of thinking, do you want to leave the vega, which means the volatility, to the market, or are you willing to sell it? Do you want to sell volatility, or are you willing to let it ride? And so this is a choice people will be able to make in the future, I believe, where you have this carry trade, those naked Bitcoin, and this cash that you need on your bank account. And you will have one slider, and you can change this quickly and say, I want more yield, I want more vanilla, more volatility exposure because I believe things will move faster, or I want more cash in my bank account, right? And depending on this, you will change that. And it will be like on a daily basis, people will ask themselves the same question the biggest hedge fund asks themselves every day. What's my current exposure? What's my target exposure? And how do I get from point A to point B? Without being a hard thinking way of doing anything. It will be just like, okay, I have this amount of money on my carry trade, like whatever, like my special bank account, like my crypto, my Bitcoin thing. And I want to get more cash because I travel and I need a little bit more right now.
A topic that I guess we didn't put into the, specific terms, but this idea of being able to be time irrelevant. So not really thinking about needing the cash within 3 months, 6 months, 9 months, a year. If you have the opportunity to say, I can ride this out, it changes the game quite a bit versus the person that's looking for specific yields within a month or 6 months. Is that, do you guys agree with that? And at least in terms of the carry trade.
Oh, definitely. I mean, the one of the worst things that can happen to you if you're in a carry trade is to be rushed out of the door, right? When you're actually not, let's say, ready to get out of your trade.
Yeah.
When there's a big carry trade unwind, one of the major components of the exit is that everyone doing this carry trade is rushing to the door. So either you're one of the first one to exit, or you can hold it long enough that you don't have to exit. This is one of the particularity of the crypto markets where you have perpetual futures. So you're actually able to, let's say, hold a carry trade for a very long time.
You're right. Right.
Getting rushed out of a trade is usually a bad situation.
That's not what you want. No one's rushing out the door at insane profits that make you happy.
I mean, the perfect example is getting liquidated, right? When you're getting so rushed out of your trade, that's change takes his cut. And
yeah.
The question for people is, do you like hot potato? Do you like to play the game?
Sure. Well, I think that's a perfect segue to the final set of questions I had for you guys today, which is a little bit about what I guess I could call forward guidance of what we're looking at for the market. We already talked about that. Today is August 5th, and we're seeing just an amazing correction in the marketplace. Just a couple of weeks ago, Bitcoin was trading at about 70K. Now it's all the way down at 50K, maybe. Now, if you think about, the things that you guys track for liquidation, for gamma exposure, what are you guys expecting to happen over the next 6 months to 18 months as this market? And just in general, the expectation that we're seeing more sophisticated players coming into the market. How do you expect that to change the metrics or impact the metrics that you guys track?
The hardest question. I think it's really hard to take a directional bias anyway, because it's always something that's correct for one day until you get more information coming from the market. What's your expectation? Lower your expectation on a daily basis to make sure you're not trying to get somewhere that's not too crazy. But overall, we interest to get back into Bitcoin when it will be more stable in the following weeks. And we might even see a huge rally back to where we started. So many people, like, this is like, people are asking themselves so many questions today. They are like, okay, so Bitcoin collapse 30%. Should I get in? At least put 10 grand or something, because everyone is like missing into it about for like the whole year from February to today that are underwater. In the following weeks, they might like give up. They might like leave the market and give the proceeds, and the difference will be paid to dealers and the new entrant coming in. And for the like a regular cycle of traders is like 90 days. In 90 days, 90% lose 90% of the money. It's kind of sad, and everyone knows that. But the thing is like, how can you avoid losing everything? It's like, follow the whale, right? Be the little guy following the whale, and use data-oriented analysis. Don't try astrology and don't try to lose and waste your time with stochastic indicator and the past. It's irrelevant. What's interesting to look at is who did what, where, and why, and understanding what's my current exposure, where do I want to get, how do I get from point A to B, taking into account that the guy did that at this point and he had more information than me.
It's real first principles thinking. I like it. Maroli, what about your take? What is going to be changing over the next 6 to 18 months in terms of the metrics that you guys look at? Are you expecting less volatility on them? If you look at toxic order flow, are you looking at the gamma exposure? How do you expect those to change as these market participants and more people come into the market?
So as the option market in crypto is expanding and growing, as more institutional players are coming, I expect the GEX effect actually to be much stronger. And actually quite interesting because we just mentioned the Gary trade. I was just looking at the data real quick. Right now, the annualized funding rate on Deribit, which is the main option marketplace, right, is at minus 100%. So net short players are currently paying 100% annualized rate. They're paying the longs 100% annualized. Why is this? So the market went down, gamma exposure turned negative. So all those option dealers had to sell, as we mentioned at the beginning of this call. For every dollar will go down. So they keep selling, keep shorting. The market goes more down because volatility increased. So now they need to short even more. And so in the end, they shorted so much that right now they completely overtook all the long position in terms of size. And they currently have to pay 100% annualized on their short. So whoever had every trade right now on Deribit is staying a bit expensive. Well, I guess, to come back to the point that the gamma exposure effect is going to be much stronger. So I will just keep increasing.
So the role of these option dealers is going to be even higher. The gamma exposure is going to be even more impactful on price movements.
The thing is, options are very interesting for creating structured products. It's basically a good way to create the trade with predefined parameters, right? So the risk, the time, volatility, everything is predefined what to do when you set option trade. This allows you to create interesting structured product that we don't need to go into the complexity right now.
Yeah.
But what people need to understand, what listeners need to understand is that those products are very popular for institutional traders, right? Not as much for retail traders, but institutional traders often put big sizes on this kind of product. And so that's why we see, I think we will see an uptick in the use of option trading, at least in terms of institutional trading. So the gamma exposure effect will be much stronger. On the other hand, I think we experienced this also with Gecko throughout the years. We've always tried to, educate the market about liquidations and the risk of liquidation, and also how to take advantage of them. And we saw that more and more, actually, as the volatility died down, liquidation also started dying down. So it's not the good old days of Arthur Hayes on Bitmex. Right? What was happening every morning or whatever.
Yeah.
Now we see mass liquidation. I don't know if you remember, we used to have a lot of what we used to call Darth Vader candles. It goes up 5% and 5% the next minute. And you have you just liquidated everyone in the market.
Yeah. Being around since 2017, yeah, you saw a lot of volatility.
Exactly. And those ones already we don't see so often anymore. Now we see it relatively often when we have those FOMC, for example, when like those big inflation numbers, job reports, and so on are released from the US. We see this kind of market behavior, which is always very interesting to take advantage of.
Mm-hmm.
But I think when people are getting more and more educated on liquidation, they understand that they lose a lot now.
Mm-hmm.
I think we will see a lot. I mean, I hope actually that we will see less use of very high leverages. But sometimes every now and then you see a new exchange that puts 250x leverage.
Yes.
It's completely ludicrous.
I was going to say, I saw that
Let's see
came
how
out
it goes.
a couple of months
Let's see
ago.
how this goes. But I think people, I mean, at some point it just becomes gambling, literally.
Of
When
course.
you know that already 100x leverage has literally 97% chance of getting liquidated within 4 hours, what are you doing 100x leverage? If you're, I mean, are you expecting to make money? Because the math says you shouldn't.
Yeah. Yeah. The dangers there are just too high. That's pure gambling, not really skill-based, if you will. Okay. So you guys have kind of shared what you guys expect to happen over the next 6 to 18 months. And obviously beyond that, the dealers will become more impactful. Hopefully retail traders can become more educated and be thinking more about liquidations and how they manage their positions.
On the
That's
other hand, if I may,
yes, please.
I think the macro environment will be very important also the next few months. We see a bit of, let's say, chaos a bit everywhere in the world right now. I mean, different kind of chaos. We see retail, let's say, retail families, retail people are more and more cash strapped, right? There's no more liquidity until they start the printer again, right? People don't have money. They don't have money to gamble on crypto. They have money actually, yes, to gamble, so 100x, but not really to invest long term in crypto. So I think that available liquidity, of course, will have a big impact on where crypto is going.
Well, let's end with a question about that. There's a lot of discussion on this bull market cycle and debate, at least on Twitter or X, about, is it left shifted? Is it right shifted? Do these cycles, 4-year cycles, have they stopped mattering? Or is the bull cycle kind of coming to an end already as we see this correction because macro is now in charge? Or are we expecting to see more of a, let's say a resurgence because liquidity will have to come back in the end of Q4, beginning part of 2025? I'll ask you both to kind of think about what is your expectations over the next, let's say again, 6 to 18 months in terms of does the market end higher or lower or not? And anything else, I guess, from a macro perspective. And I think Marley, you just touched on that. But what is your price expectation? Is the bull market over, or is the bull market going to go higher, and how high? And Marley, I'll start with you. Gecko, we'll end with you, and then we'll wrap it up.
Always hard to say price expectation, especially long term. So, of course, I mean, I'll talk for myself at least. Gecko can do it as well. Quite bullish, of course, crypto long term, especially Bitcoin. Couldn't pronounce myself on shitcoins. But I especially like to look at very short term liquidity impact on the market, right? This is what I mean, the KingFisher is great at also showing you long-term trends, right? Or long-term price targets. As I explained, for example, with this 16K buy, looking at low leverage liquidations. But for example, look at the all leverage map, you're going to see like big cluster between 65 and 70K. I think we hit this within a few months maximum, right? I don't think we're going to hang down here too long. How long is hard to say. From experience, liquidations are almost always hunted. And seeing big clusters like this are probably going to get hunted as well. Look at low leverage liquidations. I think targets are much higher, like towards almost 90K. There's a very big cluster from 72 something to 90K. So if we start chewing through this, we could get there very fast, right? You saw the beginning of this year how fast the market can go up. I think a lot of people will get surprised when we start going up again.
Yeah. But, okay. Be surprised when it starts going up. Gecko, what about you? Same question. What are your expectations for the next 6 to 18 months?
So my expectation is that all the government will try to stop the collapse of the yuan and fix the currency. we are going to see the rise of Chinese, again, printing press. So EU and the US will do the same. We are going to see interest rates cut over, I think, less than 3 months. And this discussion will lead inevitably to a disruption into the bond market, a new disruption into all the banks' profitability. And we are going to see the printing press again rising again. It was like expected for a year that the yuan will get adjusted at some point. So all the circuit breakers are slowing down the process, but it will always end up with the same solution, the printing press. And the more and more people are getting interested into Bitcoin, the more and more liquidity we are going to see lifting up all the assets. And I would say data-oriented view into the Bitcoin market, there is a liquidation cluster that has been built up around 73,000 to 86,000. And this would liquidate every single short that has been into position since almost 2 years. And with the halving and like couple dozen $1 billion that have been added up to the USDT liquidity, we can expect that this amount of money is going to be getting long right now and want to take more exposure and will lead to all-time high quite soon. It's like maybe a bias of confirmation for everyone listening to this, but I do believe that the Bitcoin is going higher this year, or maybe earlier next year. But what's going to be really surprising, it's when we reach all-time high, it will move so quickly to 90,000, 100,000. It can even lead to 200,000 before everyone blink an eyes. And there will be like a price discovery at this levels until the funding rate gets so high that the carry trade basis block the market. And then we are going to range again for like maybe 2 or 3 years, who knows. But overall, yeah, we might also get a clear around 44K, but I would say the main toxic order flow was 44K at the bottom, rock bottom. And on the downside, it started at 68. So maybe we are going to see a 51, 68, 68, 44, making volatility being quite low, 44, 88, 88, 100. And you know, it can take even like 3 more or 6 months. So don't rush out anything. If you feel the need to trade X100 leverage, just go out and buy a PlayStation, as Kobe would say. Use the money and the proceeds you have to just enjoy your life and the summer. Don't burn yourself. Build stuff, make money, invest into it, build a carry trade. Use the interest of the proceeds to make more Bitcoin and get vanilla naked exposure from the proceeds of the interest. Slowly get into it. If you enter a carry trade and you see the price going down and you feel that you have huge P&L from the carry trade because just of the USDT difference paying you what the Bitcoin drawdown would have been, and you feel that, oh, wow, that's a lot. Maybe a lot of people will think the same thing, having taken directional exposure, and you can start to unwind a little bit and just get naked Bitcoin. Let the market ride higher, and think always in a I want cash, but in a safe way, and save BTC this way overall. And you're going to be ready to get 81K BTC up, and you will be the guy being long at the rock bottom, having collecting interest for 3 or 4 months. Yeah, for sure.
I love it.
Easy way.
I love it. Gecko Maroli, thank you so much for stopping by the studio and breaking down all the great work that you guys do. For the audience, where can they find you? Where's best to be following you guys, your thoughts, your products, all that?
Yeah, you can follow.
I think is to follow us on Twitter on KingFisher_BTC. I think, of course, on the KingFisher.io website as well. And also we have a very active Telegram channel and Telegram chat where you can find few thousand people doing liquidation all day. They're interesting.
When they're not touching grass, they're reading about liquidations. I love that.
Yeah.
All right. Well, guys, thank you so much, Maroli, Gecko,
so
again,
much
for dropping by. Love the conversation. We're going to have to bring you guys back as this this bull season continues, especially as we start to see some of those price targets move on up. And if you haven't already, be sure to subscribe to the Exchanging Good channel. We're going to be bringing back more guests like this, so you're not going to want to miss them as we bring them on. But with that, we'll wrap it up. Thank you, guys. This is Marconi White signing off.
Thanks a lot, Mike.
Thanks.